everyone, it's Emily Duplessis here with Rental Rookie. Today's video is going to focus on the concept of an ROI, or return on investment. One of the reasons that I want to take some time to talk to you all about it today is that the ROI is an extremely important figure when it comes to investing. And actually, in reality, an ROI is a term and a figure that is used across the board no matter what you're investing in. But today we're going to look at it in terms of investing in real estate, right? And specifically rental property. So in this video we're going to talk about what an ROI is, talk about the difference between a high and low ROI. We're going to look at why it's important, why does it matter, why should we make this calculation, and then we're going to take a look at an actual sample of our property analyzer and take a look at some numbers itself to figure out how to calculate it. So without further ado, let's get started. What is an ROI, right? ROI stands for return on investment, essentially meaning that you are going to take money and you are going to invest it in something. You can invest it in stocks, in bonds, in mutual funds. In our case, we're talking about real estate, and we are looking for some sort of return on that money that we invested, right? So think about it. A lot of times today, people don't just leave their money in savings accounts anymore, because if we just throw it in a savings account at a bank, we're making pennies off of a lump sum of cash that we have sitting in the bank, where we can actually take it and invest it in something, like I said earlier, whether it's the stock market, in our case it's real estate, and look for a higher return on the money that we invested. And so this ROI figure is extremely important when it comes to investing, because we want to know, okay, if we put our money here, what are we going to get back, right? That's the whole concept of return on investment. If it's still a little bit confusing, you can think of it like in terms of time, right? We invest time in all sorts of things. So let's pretend that we are basketball players. Maybe you have a child that plays basketball. Maybe you played basketball when you were younger. But you take this time and you're super dedicated, right? You are constantly practicing. You're on the team. You practice at practice. You practice by yourself afterwards. You stay after and you shoot foul shots till you make 100. You're doing king ball drills all the time. You're doing extra lifting workouts. You're doing speed and agility workouts. And you're putting in all of this extra time, right? So in this example, your investment is the time that you're putting into practice, right? Your return then, what you're looking for as a return in our basketball scenario, is that when it comes to game time, that one, you're going to play a lot, two, that you're going to do well, right? You're going to score a lot of points, and three, hopefully that you're going to lead your team to a victory. So that is your return on the investment of your time in practicing, right? So this whole concept of we invest in something because we're looking for a return. So when it comes to our case, putting it into perspective with real estate, and more specifically with rental property, we're looking for ROIs, and that is going to be related to the concept of getting cash flow each month, right? Because we're holding onto properties, we're not buying and flipping them. We're not necessarily looking to get into wholesaling and those sorts of things yet. Right now we're just buying properties, and we want to hold them, and we want to rent them long term, and we want to make money off of it. So in our case, let's talk a little bit about high and low ROI. A high ROI, right? So this concept that you're going to invest money and you want that investment to yield a high amount back to you. Now, one of the things that you have to realize is that when it comes to investing in rental property, everybody is going to have maybe a different threshold of what they consider as high and what is considered low in their own mind, right? So let's say on average maybe you want to say 15% ROI. That's what you want to look for. If you can get 15% or more, that's going to be a fairly good ROI for you, right? But again, you may be somebody who's invested in a lot of properties, and maybe you have a ton of properties, but they yield maybe a little bit lower ROI. So maybe you're only getting 11% or 10%, but you have a ton of properties that are each getting 10%. So that money adds up. Or maybe you are somebody who has invested in only a couple of properties, so you are looking for a higher return because you're only investing in a couple. So you need those properties to yield you something higher. So you have to realize that everybody's kind of version or number is going to be a little bit different. But this concept is you need to think about, what is my threshold between a high ROI, something that I'm looking for, and a low ROI, right? So a low ROI is where the amount that you earn that is returned off of your investment is relatively small compared to what the lump sum of cash is that you invested initially. Like I said, maybe 15% is a good number, just an average number for you to shoot for. I'm going to show you a sample here for using our property analyzer for a property that my husband and I own, where it was actually our very first property that we invested in, and we started off making 25%. So we kind of started off, and maybe that was a good thing. Well, it obviously was a good thing, but it also was kind of a bad thing because it's made us kind of push for and be picky when it comes to getting properties and what that ROI is going to be. Let's talk a little bit about why it matters, right? Who cares? Why do we have to pay attention to this number? Why do I need to take time calculating it? I like this property. It's going to give me cash flow every month, so who cares? An ROI is going to tell you, it's a raw figure, right? It's a percentage figure. It's purely based off of numbers, and it's going to tell you whether or not how efficient your investment is. How effective is that investment? Is it something that is worth me investing my money and time into? The nice thing about real estate and investing in rental property is that we calculate this number ahead of time. Now, it might not be 100%, but it's fairly accurate. So we're going into investments knowing I'm going to buy this property and it's going to yield me a 20% ROI. That's awesome that we can know that ahead of time, that we don't have to blindly invest and say, okay, this stock is doing well right now, so I'm going to go for it. And then you don't really have control over what's going to happen because the market is so volatile, right? Not to say that the real estate market there isn't volatility in the real estate market, because there absolutely is. But the great thing about investing in real estate is that you have a fairly accurate figure, an ROI figure, before you even invest. And you can say, yes, this is going to work for my goals and what I want, or no, you know what, this isn't going to work, we're going to keep looking. So that raw figure is going to tell you about the efficiency of your investment. Let's take a look at a sample property ROI that I have for you today. This is, if you can take a look at it, this is our property analyzer that you can download free from our website. It has all sorts of information, or it's going to prompt you to put in a bunch of numbers, and they're in the yellow boxes, and the white boxes already have formulas in them, and they calculate everything for you. So there are three numbers that I want you to pay attention to. You'll see that there is the $21,269. And then there are two numbers in the red circles, $449 and then a little over $5,000. Those are the three most important numbers when it comes to calculating an ROI, right? So in our case, with the property analyzer, it already calculates it for you. So if you have this, it's great because all you have to do is input your numbers in the yellow boxes and it's going to calculate everything for you. You're not going to have to worry about it. But if you don't have our property analyzer and you have to just run the numbers yourself when you're at a property, and you have to pull up your calculator and just throw some information in right away, how do we calculate that ROI? What numbers do we need to pay attention to? And like I said, those numbers are circled in red. So if we take a look, the equation is you want to take your total yearly net income, which in this case was $5,385, right, if we look at the spreadsheet here, and you want to divide that by what your total cash was that you invested. So in our case, it was $21,269. So you take those two, you divide them, and that gives you your ROI. So in this case, with this property, we were yielding a little over 25% ROI. In essence, that number then, that percentage tells me and tells my husband that, okay, in approximately 4 years, we are going to have earned back all of the money that we have invested from the beginning in 4 years. And after that, then it's pure profit. Yes, we're still going to be paying a mortgage, or our tenants are still going to be paying a mortgage and condo fee and those sorts of things. But after 4 years, everything that we make on that property is going to be pure cash flow, pure cash in our pocket. So it only taking 4 years is fantastic. So again, like I said, it's a great thing that we started off investing in something that had such a high ROI, but at the same time, it's made us very picky in terms of what we want in other properties. So maybe that's not such a good thing. But again, this whole concept, knowing that up front can help ease of mind. I mean, we're talking about your money. We're talking about your financial future whenever we're dealing with investing in real estate. And so you want to know when you're going into something, yes, this is going to be beneficial, this is going to pay off, this is going to be lucrative. Figuring out that ROI is going to tell us that, because like I said, in this case, after 4 years, we have all our money back and everything is just pure cash. So again, I hope that kind of recircling back to the beginning, that you kind of understand this concept of ROI and why it's so important, right? So ROI, our return on our investment, we put down money, we put in money, we were looking for some sort of cash in return. We have the high and the low, and again, that may differ for you depending on your goals as an investor, depending on the property. And then again, how you calculate it. You want to take the total yearly net income, so take all the cash flow that you make each month. Like in our case, it was $449. It might be $500, it might be $300 in your case. You want to times that by 12 to get your yearly income. Divide that by your total cash invested, and that's going to give you your ROI. So last thing I want to say, that if you don't have our property analyzer, okay, on the video here you can see that you can click, I have the link. You can go ahead and go to our website and download that. It's free, you don't have to pay anything. With that will come 3 spreadsheets. You'll have one for single unit dwellings, so that'll be for single families, condos, townhouses. There's one for multi-unit, so duplexes, triplexes, etc. And then there's also one for student rentals. So if you're interested in investing in student rentals, you can pick all those up for free at our website. So I hope that this has helped out in terms of you understanding what an ROI is, and happy investing.